Hello, Steve here with iMortgage Solutions, iMortgageBroker.com. Wanted to talk about purchasing a home from the mortgage perspective. So the process of getting pre-qualified and purchasing a home from the perspective of arranging a mortgage. So the first step is the qualification process, and basically what we do is go through an application which includes your name, your address, your birthday, social insurance number, employment and income details, as well as your assets and liabilities. The next step is to get some documentation. So we need you to sign a credit authorization form, and then we would look for income confirmation, employment confirmation, and these come in a number of different forms depending on what you do. So if you're a salaried employee, we look at an employment letter which states your position, salary, tenure, and also accompanying that is a recent pay stub within the last 30 days. If you're a salaried employee with bonuses, then ideally the employment letter should include what your base salary is, as well as details about what your last two bonuses were. So if in 2011 you made $10,000 and 2012 you made $12,000, then those should be stated on your employment letter as well. And again, with this, you'd also need a pay stub to accompany the employment letter. If you're an hourly employee, then again, an employment letter stating your position, hourly rate of pay, number of hours that are guaranteed. Now, guaranteed, that's important to state on the letter that you are guaranteed 40 hours or 36 or whatever it may be. Also, your tenure is important, so when you started there or how long have you been working there. And again, the employment letter should be accompanied by a pay stub. If you're an hourly employee earning overtime, then in addition to the employment letter and pay stubs, we can include the last 2 years of your notice of assessments to confirm additional overtime, etc. you've made before. So a notice of assessment is the form you get back from the government after you file your taxes. Some lenders also want to see copies of your T4s in addition to the notice of assessments. If you're self-employed, then typically what we use is the last 2 years of your notice of assessments, as well as your T1 generals. And if you have a limited company, then corporate financials for the last 2 years is also something that's requested. We would use the 2-year average to determine what you qualify for. The next step of qualifying or pre-qualifying is down payment confirmation. There's a few different things you can do to verify your down payment. If you have a savings account and that's where the money is, then we need a statement for the last 3 months showing the account history. It also has to include your name and address as well as a financial institution. Many banks don't offer statements any longer, so if you wanted to print something online, you want to make sure that your bank account or your bank is showing on the statement you print, as well as your name and address. So you need something to verify those two things. Also, if there are large deposits in your account over $5,000, often the banks will want to see verification of where those funds came from as well. Investment statements are another thing you can use to verify your down payment. RSPs, stocks, mutual funds, TFSC, GIC accounts. Again, we need a 3-month history on those as well. And the other thing you could do is get a gifted down payment. If your down payment is gifted, then we'll need a gift letter stating that the funds are given to you and you don't have to pay them back. One important aspect of the gifted down payment is to make sure that you deposit the funds into your bank account. The bank wants to make sure that you receive these funds, so don't have the funds directed to the lawyer or given to the realtor. It should be deposited directly into your bank account. So the pre-approval process, when we qualify you, there's a couple of things that we look at. If you have less than 20% down, then we arrange something called a high ratio mortgage. High ratio mortgage is an insurance premium that's added onto the mortgage, and basically in 1952, CMHC was created to allow Canadians to purchase a home with less than 20% down, and so they insure the mortgage for the bank, and there's an insurance premium that's charged or added onto the mortgage to allow the bank to lend you more than 80% of the value of their home. 2 other insurance companies aren't government owned, are Genworth and CG, and as you can see, as the down payment increases, the premium reduces to a point where you have 20% down, there's no premium. Also, if you See on the right hand side there, if you're self-employed, may not show all the income you really earn, have a lot of deductions, have a lot of expenses and write-offs. You can state your income. You have to have a minimum of 10% down, and you also have to have good credit to state your income and qualify under the stated income high ratio purchase. The other thing we look at is how to qualify. So if we're qualifying based upon your income, we use two numbers. The GDS, or gross debt servicing, can be 35% of your income can go towards a principal and interest payment on your house, the property taxes, heating your house, and then half the condo fees. And then the TDS, 42% of your income can go towards all of the house payments listed above, as well as minimum credit card payments and line of credit payments. Minimum meaning interest only if it's a line of credit, or 3%, 2%, but typically we use 3% for credit cards and lines of credit. If you have a really good credit, we can actually increase the TDS, GDS numbers to 39 and 42, 44, but you have to have a beacon score higher than 680. A beacon score is something that's scored by Equifax and shows it's an analysis of your credit usage and history, etc. Once we have you pre-approved, then it's time for you to go out and look for a home. So you'll search around to try and find a home that you like, and once you find one, you're going to write an offer to purchase. When you write an offer, you have to give a deposit. So you'll write up the offer, negotiate a little bit, give a deposit, normally $5,000 or sometimes as much as 5% of the purchase price, but normally a few thousand anyway, to show your interest in the purchase of the home. Once you've written the offer, it's been accepted, then you have to send that documentation to the mortgage broker, and we'll need a copy of the offer and any addendums that were included, as well as a copy of the MLS listing feature sheet to show the details of the property, including the address and any property taxes, condo fees, etc. Once we receive that documentation, we'll put everything together again and send it back to the bank to have you approved and qualified with the purchase as well as yourselves. Depending on the down payment, we may need an appraisal. There may be some other things that may need to be done, and the lender will review everything and then let us know exactly what they require, any additional documentation that we may not have sent them originally. The lender will send us that information in a commitment. Commitment is a commitment on their behalf to lend money to you. So once we receive the commitment, we review it, sign everything, order the appraisals if required, verify the down payment, the source of funds, those 3 months, and any other documentation that the lender may require. We send all of that back, and once it's accepted, then we meet once again to finalize the commitment. Again, sign the commitment letter, review the payment frequency. You set up the void check with us so that we know which bank account it's coming from. We'll review your insurance needs. We have creditor insurance available for the mortgage, or there may be some other insurance needs that you may be interested in. And then we submit all of these final documents back to the lender so that they can forward the instructions to the lawyer. The lawyer will review or will receive the mortgage instructions from the lender, typically about 2 weeks prior to possession, and they'll have you in to sign. This is when you give the balance of the down payment. So if you gave $5,000 down as a deposit when you first wrote the purchase, then this is when you'll give the balance of the down payment minus the $5,000 you originally gave as a deposit. You also have to pay the legal fees, any property tax adjustments. Sometimes there's title insurance fees and other things. This is where you pay most of the costs associated with the purchase of your home. And once you're finished there and signed, about a day before the possession, typically you'll go with your realtor and look at your house again, make sure that everything's there and everything is satisfactory, and on the day of your possession you'll receive the keys and then move into your new home. So this was a review of the home buying process from the perspective of arranging the mortgage. Thanks, it's Stephen Cruz with iMortgagebroker.com.